Hi, thanks for checking in. My name's Trevor Russell. I'm the director of the Results Investment Group. I just want to let you know that this is for education general purposes only. This is not financial advice. You always should seek professional advice before considering any financial decision. And if you don't have a professional financial advisor, please reach out and we can introduce you to someone who can speak to you about your specific needs in this area. Clients when they're looking to transition their money from an employee super fund with the goal to invest in property to achieve a higher leverage return on longer term asset and income wealth. And this is not telling anyone they should or shouldn't do this. It's just to see how the numbers compare. But again, just to give you an idea of the possibility of what a self-managed super fund property investment can achieve versus going just down the traditional route of an employee super fund. We've got someone here, they're currently on around 140,000 a year. Super contributions are 16,000 average a year. They've got about 180,000 that will be rolled over into their self-managed super fund account that we will use to acquire the property and set up the loan and pay for the relevant fees. 126,000 dollars, 180, 53,000. Working on some projections again, renting that property out for say 520,000, achieving X amount of income, and I've calculated it at 48 weeks just to be safe. And the employer contribution. And because there is a little bit of shortfall in relation to the income versus the expenses, we're proposing that there would either be the contribution from the investor into the fund, or they can access the money out of here to cover any shortfall but making sure that there is surplus funds in the account so that after outgoings we achieve a profit. Now, of course, rent will go up over time and eventually this will diminish and it will be a self-funded investment in the super fund. And this isn't always the case because different people are in different financial situations. Sometimes this isn't required, but for this example that we've been working on, this was going to help with making the numbers work. And then coming down here, loan repayment plus offsetting the surplus money in the account gives us an estimated annual loan return plus the ongoing management and audit of the super fund, council rates, property management, landlord insurance, tax on income and contribution. Yes, you do pay tax in a self-managed super fund and you also pay tax in the employee super fund. It's just that between the employer and the super fund, they do the tax for you. That's why you don't see it. They do that and you get the end result. Loan repayments for the super fund. And this, let's look at the long-term potential. Again, these are just projections, but just to give an idea of the difference. Working on that property at a $500,000 purchase price at a 9% average growth, and properties, they range depending on where it is and how long the person's held the property. The good thing with self-managed super fund property investing, it's always a longer term strategy. Here we're looking at 21 years for this projection and this example, and some areas are achieving 12%, others are 7%, others are much more, but we're just working on a metro area that we will get good consistent capital growth. So I've worked on a 6% rental yield growth. Again, some areas are lower, some are higher, but that's what I've worked on the numbers. So 21 years in the future, we've now got an asset of worth over $3 million and we've got a before cost income of $91,000 in rental income. Now, because rent increases over time, this property would be paid off well, and because we're getting a super contribution, this contributes to helping this loan get paid off sooner. So we generally see properties in a super fund that are generally paid off anywhere from 12 to 20 years in, depending again on the numbers. So we've got a loan debt-free asset and with outgoings for this small property at 500,000, and they do exist. There are areas still in Australia, in Melbourne, Adelaide, where you can, and other areas we know that you can buy a good $500,000 house or apartment, and we're looking at a net after cost income of $76,000. Now, that is in today's dollars, of course, and we've got inflation, but let's consider this. Would you rather, for this person's example, even if it's in tomorrow's dollars, a $50,000 ongoing income and underlying owned assets versus if we go down this path of the employer super fund, we are looking at, this is meant to be 21. We're looking at the same numbers after tax. We're looking at 708,000 in rough dollars versus a $3 million asset that's owned and an ongoing net income of 76,000 in today's dollars. As we can see, it's vastly different. Now, I do understand. We know for a fact this is not for everyone. There is work involved. There is a lot more moving parts to it. But for the right person, with the right attitude, with a long-term perspective, and the numbers work, this is a very real strategy that a small handful of Australians are doing to really transform their super money into a far more substantial asset and income net worth come retirement. Again, these are just example numbers only. It does not take into your particular situation. It's not confirmed. It still needs to be run through with the lender. They need to check serviceability. But just to give you an indication of how we start the numbers process, and if you'd ever go through this exercise with us, we'd be happy to help you look at the numbers and explain how it works and if it could be something that could be a benefit to you or someone that you know. Hope you found this helpful. I'll put our contact details below. If you'd ever run the numbers and have a chat, it would be an absolute pleasure. We also do all forms of home finance, refinancing, property investing, business loans, commercial loans, and we also do give it support and guidance around budgeting your money, getting on top of your finances to get in the profit zone, as I call it, or the green zone. So please reach out. But for today, that's a quick example of how we run the beginning numbers to look at what could be possible for someone who's wanting to consider moving into a self-managed super fund to buy a property and build longer-term, retire rich wealth. Thanks so much for watching. Hope to speak to you soon.